Welcome to the deep dive. So today is June 5th, 2026, and the Dow just hit an absolute record high.
Yeah, quite the milestone.
Right. I mean, the U.S. economy is humming along. The May jobs report shows just incredible strength, and unemployment remains, frankly, impressively low.
It's pretty striking.
It is. On paper, it looks like this absolute golden age for the markets. Yet, if you look at the stack of briefings we have for today's deep dive, investors are terrified.
They really are.
Yeah, the trading floors are basically bracing for impact. Crypto is seeing a massive sell-off, and capital is shifting at a velocity we honestly haven't seen in years.
It's a massive rotation, yeah.
So let's unpack why. Our mission today is to cut through the noise of this massive economic contradiction. We want to solve the puzzle of today's market action for you and really help you understand why, right now, good news is suddenly feeling incredibly dangerous.
Well, the reality is we are looking at a real-time stress test of the entire financial system.
Wow.
Yeah.
Real-time stress test.
Exactly. I mean, for the last 12 months, anyone managing a portfolio, and that might even be you, just looking at your own retirement accounts, has been operating under this single unifying assumption.
Right, the assumption that things would cool off.
Yes. The assumption was the economy would eventually cool down, inflation would retreat back to normal levels, and then the Federal Reserve would step in to cut interest rates.
Right, so the expectation was just a basic return to cheaper borrowing.
Precisely.
But this exceptionally hot May jobs report basically shatters that assumption, doesn't it?
It completely blows it out of the water. If employers are still hiring aggressively and consumers still have, strong paychecks to spend, inflation has a very high chance of remaining sticky.
Sticky inflation, yeah.
And if inflation stays sticky, the Fed simply cannot lower the cost of borrowing. They just can't.
So Federal Reserve Chair Warsh is facing a pretty defining policy test right now.
Oh, absolutely. The market was so confident in impending rate cuts, but the underlying data just, it refused to cooperate.
Yeah, it really did.
If we examine the prediction markets that were highlighted in the briefing, the shift in sentiment is staggering.
Actually, let's pause there and define what we mean by prediction markets for a second.
Sure, good idea.
Because they operate quite differently from a traditional stock exchange. Instead of buying a share of a company, traders in a prediction market are placing direct financial wagers on real-world outcomes.
Right. It's like a betting market for real events.
Exactly. It's a highly accurate, crowdsourced forecasting tool. And the numbers they are generating today are intense.
They really are. The traders in those markets are currently pricing in a 52% chance that the Federal Reserve will actually increase interest rates this year.
Wait. Increase, not just hold them steady.
Yes, an actual increase. We have flipped entirely from pricing in a guaranteed rate cut to bracing for a potential hike.
That is wild.
And the immediate ripple effect of that expectation is that yields on U.S. Treasury bonds, the baseline return you get for lending money to the government, they are climbing rapidly.
So how does that dynamic work on the ground? Like, why does a strong job market and climbing bond yields make investors feel so anxious?
Well, it comes down to the cost of capital.
Right. Think about interest rates, not just as a dial the Fed turns, but kind of like the cost of oxygen in a room full of athletes.
Okay, I like that analogy.
Yeah, if you are a business, capital is your oxygen.
Yeah.
So when the Fed raises rates, they are basically making that oxygen much more expensive.
Exactly.
So the athletes, the companies, they have to work twice as hard and spend twice as much just to maintain their current pace.
That analogy perfectly illustrates the mechanism at play here. It fundamentally alters the cost of doing business. Furthermore, when government bond yields go up, the return on the safest investment in the world goes up.
Right.
The U.S. government is essentially guaranteeing you a highly attractive, risk-free return for doing nothing but parking your capital.
And that creates a massive hurdle for everything else in the financial ecosystem,
A
right?
huge hurdle.
Like, if you are an investor and you can secure a guaranteed 5 or 6% yield from the government, your threshold for taking a risk on, say, a volatile tech startup or a cryptocurrency gets significantly higher.
Yep. The capital naturally and honestly rapidly drains out of speculative assets.
Makes sense.
We're seeing this gravitational pull most clearly in the crypto markets today. Bitcoin has cracked below $60,000, dropping to its lowest level since October of 2024.
Wow.
Yeah, the momentum that fueled its rise over the past year is just dissolving.
I do want to challenge the prevailing narrative around this drop, though.
Okay, go ahead.
Because when we see Bitcoin fall below a psychological barrier like $60,000, the financial media immediately screams that investors are panicking.
Right, the panic narrative.
Yeah,
Yeah.
but looking at the broader economic data we just discussed, is this actual panic, or are institutional investors just staring at a spreadsheet, seeing the new higher bond yields, and aggressively recalculating their risk models?
It's the latter. The underlying data points firmly to a ruthless recalculation rather than blind panic.
Yeah, that's what I thought.
Large-scale capital managers are liquidating their most volatile positions simply because the mathematical risk premium no longer makes sense.
It's just a math problem for them.
Exactly. It's a
Uh,
purely defensive reallocation of capital. However, and this is important, the math of interest rates isn't the sole factor driving this defensive posture today.
oh, right, the geopolitical angle.
Yes, the briefing also highlights severe geopolitical fragility that is actively exacerbating the situation right now.
Yeah, the oil markets are looking incredibly vulnerable right now,
Yeah.
specifically due to escalating threats from Iran regarding the Bab el-Mandeb Strait.
This is a critical variable in today's market anxiety. The Bab el-Mandeb Strait is a massive maritime choke point for global shipping,
Especially for crude oil,
right? Particularly for crude oil moving out of the Middle East. If that strait is compromised or closed, the global supply of accessible oil shrinks basically overnight.
Which creates an immediate supply shock.
Immediately.
Oil prices would spike. And since oil fuels the transportation of virtually every consumer good on the planet, that price spike feeds directly back into the inflation problem we started with.
It's a vicious macroeconomic feedback loop.
It really is. High employment keeps inflation sticky, which keeps interest rates high, which pulls down speculative assets.
Yep.
Meanwhile, geopolitical threats risk a massive oil spike, which would drive inflation even higher, forcing the Fed to potentially raise rates again.
And when you map out that feedback loop, the contradiction of the Dow hitting a record high starts to actually come into focus.
How so?
Well, the broader indices are currently being propped up by a select group of mega-cap companies that possess impenetrable pricing power.
Oh, meaning they can just pass higher costs directly to the consumer.
Exactly, they have that luxury. But beneath the surface of those indices, speculative money is evaporating fast.
It makes complete sense that high-risk assets like crypto are draining in this environment. But what is genuinely shocking in today's briefing is that this same financial gravity is pulling down the supposedly safe tech giants too.
It is fascinating to watch.
We are witnessing what looks like a historic unwinding a great tech rotation.
Yeah, for the better part of a decade, the default strategy for managing a portfolio was remarkably simple. Just load up on legacy tech.
Right, your classic set it and forget it strategy.
Exactly. NVIDIA, Apple, Microsoft. They were treated almost like sovereign entities, seemingly insulated from normal market pressures.
Totally.
But today, capital is actively flowing out of those established names.
And if billions of dollars are flowing out of legacy tech, it has to be going somewhere. I mean, it isn't just sitting in cash accounts losing value to inflation.
Definitely not.
The most active stock on the board today, the absolute center of gravity for all this moving capital, is SpaceX.
Yes. The sheer volume of capital moving into SpaceX today redefines how we understand the technology sector right now.
This is wild.
The source material outlines a deal that completely alters the competitive landscape. Google has agreed to pay SpaceX $920 million a month.
Nearly $1 billion every 30 days. Let's really unpack that. Why is a legacy giant like Google handing over that kind of cash to a newer entity?
It's all about infrastructure.
Right. It's specifically for compute capacity at XAI data centers.
To understand the magnitude of this transaction, you have to look at the physical reality of artificial intelligence. We often conceptualize AI as software, right?
Yeah, it's just code floating invisibly in the cloud somewhere.
Exactly. But advanced AI requires massive physical infrastructure. It requires data centers the size of shopping malls.
Oh, wow.
Yeah, and they're packed with thousands of highly specialized GPUs, drawing enormous amounts of electricity and requiring intense cooling systems.
Building those physical data centers takes years. A company has to acquire the real estate, secure massive power grid contracts, source the cooling technology, and get to the front of the line for the actual semiconductor chips.
It's a huge logistical nightmare.
So Google clearly realizes they just do not possess enough of this physical infrastructure to support the next generation of AI models they are trying to train.
Meanwhile, SpaceX, through its integration with XAI, recognized this bottleneck years ago and aggressively built out this capacity.
They saw it coming.
They did. They have the physical infrastructure up, running, and scalable. This isn't a space race anymore. It is an AI infrastructure arms race.
That's a great way to put it.
And Google is essentially renting out the computational power they desperately need because they cannot build it fast enough themselves.
They are paying a massive premium just to stay relevant in the AI conversation.
Yep.
But we should clarify for the listener that simply having your name attached to artificial intelligence isn't a golden ticket. Because the briefing points out that a company called Nebius is actually one of today's biggest market losers.
Yes, Nebius serves as a perfect case study in how the AI market is rapidly maturing. They are an AI infrastructure company, but they lack the massive proprietary scale and established power contracts that an entity like SpaceX possesses.
And that matters now.
It matters a lot. 2 years ago, investors would blindly throw capital at any company promising AI infrastructure.
The classic hype phase. If a CEO put the letters A and I in a press release, their stock valuation basically doubled overnight.
Exactly. But that hype phase is definitively over.
Yeah.
With interest rates hovering where they are, the market is no longer funding vague promises. Investors are demanding tangible proof of execution and an impenetrable economic moat.
They want to see the actual hardware.
Right. They are actively rewarding the companies that hold the literal keys to the physical servers, and they're punishing companies like Nebius that might be structurally sound but simply cannot compete at $1 billion a month scale.
So if Google is willing to pay nearly $12 billion a year just to rent server space, imagine what it costs the other legacy giants to build their own infrastructure from scratch.
It's staggering to think about.
It is. And this brings us to the scramble happening right now across the older tech monopolies. Meta is taking a brutal beating on the markets today.
Yeah, the financial burden of remaining competitive in the AI era is becoming painfully clear to shareholders right now.
Yeah, reports today indicate Meta might issue a massive stock offering.
Exactly. They're looking to raise tens of billions of dollars specifically to fund their proprietary AI infrastructure build-out.
Let's actually explain why the market reacts so negatively to that news. When a company issues new stock, it is essentially creating new slices of the corporate pie.
Right, dilution.
Exactly. Which means the slice you already own as an investor becomes smaller and inherently less valuable. It's like Meta is passing the hat around to its current shareholders to fund the construction of a multi-billion-dollar mansion, and the investors are finally balking at the price tag.
The market is sending a very clear, uncompromising message to Mark Zuckerberg here.
Yeah, it is.
Investors believe in the long-term potential of AI, sure, but in a high-interest rate environment, they are unwilling to absorb the cost of a multi-year, capital-intensive science project.
They just won't do it.
No. The demand for an immediate return on investment is paramount right now.
And Meta isn't the only legacy giant feeling the heat today. Apple is heavily active on the board, and the sentiment surrounding them is incredibly tense.
Very tense.
They are heading into WWDC, the Worldwide Developers Conference, which is their massive annual event where they set the software and hardware agenda for the coming year.
Right, the big keynote.
Yeah, and the briefing emphasizes that Tim Cook's AI legacy is entirely on the line at this event.
Apple is perhaps the most fascinating example of this legacy tech scramble.
Why do you say that?
Well, for over a decade, their unparalleled ability to design and sell premium consumer hardware completely shielded them from broader market fluctuations.
Right.
They own the consumer endpoint, the beautiful phone in your pocket.
But the paradigm is shifting rapidly away from the endpoint, isn't it?
Exact.
In a world where foundational AI models and massive data center compute are the new fundamental currency of the tech sector, having the nicest phone hardware just isn't enough anymore to justify a multi-trillion-dollar corporate valuation.
It's just not.
If Apple doesn't show up to WWDC with a proprietary AI solution that proves they're a dominant player in this new landscape, that capital rotation out of legacy tech is going to hit them relentlessly.
Absolutely. And, the demand for concrete, immediate utility extends well beyond consumer tech platforms.
What else?
We are seeing the exact same dynamic play out in the cybersecurity sector today. The briefing specifically highlights a company called Mythos.
Oh, right, Mythos. They've been leading a massive rejuvenation of the cyber sector recently.
They have.
They are positioned as a next-generation security firm, specifically utilizing AI to fight emerging AI-powered cyber threats. But their latest earnings report just poured cold water on their entire stock rally.
Yeah, because cybersecurity is fundamentally an arms race.
Right.
Malicious actors use AI to find network vulnerabilities faster, so corporate defenders require better AI to predict and patch those holes.
It never ends.
Right. Mythos saw its valuations skyrocket based on the theoretical promise that they held the ultimate defensive shield against these new threats.
But an earnings report forces a company to show its actual contracted revenue, not just its theoretical potential.
That is the reality check the market is enforcing right now.
Show me the money.
Exactly. Whether you are building enterprise AI models, consumer hardware at Apple, or cybersecurity defenses at Mythos, the era of speculative valuations is dead.
Completely dead.
When the baseline cost of capital is 5 or 6%, your innovation has to generate tangible, verifiable revenue today, not 5 years from now.
Well said. We spent a significant amount of time unpacking this massive abstract war happening in the digital realm, right?
Mm-hmm.
Tech giants fighting over data centers, issuing stock to buy GPUs, battling for AI dominance.
Yeah, a lot of digital battles.
But my favorite part of today's briefing is how it forces us to look away from the screens and focus on the physical world. While the digital economy scrambles to justify its costs, the physical economy is fighting back and actually winning.
It's true. The bifurcation between the struggles of digital platforms and the triumphs of industrial applications in today's market is striking.
Just look at the top gainers on the board today. You have Boeing surging because they're launching a new 737 MAX production line.
Physical manufacturing.
Exactly. We're talking about real metal, real rivets, physical factories. Then you have Amazon up significantly. And it's not because of a new cloud software update, but because they unveiled a brand new physical warehouse robot.
Right, hardware again.
Yeah. And then you have Berkshire Hathaway making a massive move to invest in Alphabet.
Now, the Berkshire Hathaway move is incredibly revealing.
How so?
Well, Warren Buffett's conglomerate is notoriously averse to speculative technology. They prefer to buy tangible assets like railroads and insurance companies.
Right, boring stuff.
Exactly. Boring but profitable. So for Berkshire to step into Alphabet now indicates they no longer view the search giant as a high-growth tech play, but rather as an undervalued essential utility.
Like treating it like a water company or a regional power grid.
Exactly. It's infrastructure to them now.
That makes a lot of sense.
Yeah.
Let's focus on Boeing and Amazon for a second to really understand why they are winning today. Because if you look at an Amazon warehouse robot, how does that actually move the needle for a company of that size, especially when compared to the struggles of digital platforms like Meta?
Think back to the hot May jobs report we discussed at the top of the deep dive.
Okay, the strong labor market.
Right. The labor market is incredibly tight. Human workers are expensive, and retaining them is difficult.
Very true.
An Amazon warehouse robot is a tangible piece of technology that directly replaces human labor, immediately lowering the cost of logistics.
So it's immediate impact.
Yes. It is technology applied to physical efficiency rather than technology applied to abstract consumer engagement. It drives profit margins up the exact day it gets plugged in.
Wow. And Boeing opening a new production line means they have a physical backlog of airplane orders they are finally fulfilling, which translates directly to immediate cash flow. They're solving physical problems.
Exact.
Which actually explains the biggest non-tech loser on our board today perfectly.
Yeah.
Lululemon.
Oh, yeah. Lululemon has entirely cut its annual outlook.
Entirely.
They're proactively warning their investors that financial conditions will deteriorate further before they improve.
The briefing cites, negative media commentary and poorly received product launches. But if you connect it to the macro picture we started with, the failure makes total sense.
It really does.
When the cost of oxygen in the economy goes up, when rent is higher, grocery bills are up, and credit card interest is actively squeezing the consumer, a new pair of $100 yoga pants is the very first thing you cut from your household budget.
Yep. Discretionary spending goes first.
Exactly. Lululemon is entirely dependent on consumer discretionary spending.
The market is engaging in a brutal, highly efficient sorting process right now.
Sorting process, I like that.
Yeah, it is separating the economically essential from the highly expendable.
Right.
The winners are companies providing foundational infrastructure like SpaceX's massive compute capacity, or companies driving hardcore physical efficiency, like Amazon's robotics and Boeing's manufacturing lines.
And the losers.
The losers are companies reliant on stretched consumer budgets or legacy tech platforms trapped in bloated digital valuations without a clear, immediate path to AI profitability.
So let's bring all of this together. If you are reviewing your investments tonight, or maybe adjusting your corporate business strategy, or just trying to make sense of the financial headlines, what is the ultimate takeaway from this June 5th briefing?
The primary lesson is that the investment playbook of the early 2020s is fundamentally obsolete.
It's dead.
It's completely we are operating in an environment defined by intense interest rate uncertainty and massive capital shifts.
Yeah.
In this world, true diversification requires paying attention to where the capital is actually flowing today, not where it historically lived.
Right.
Capital is flowing aggressively into hard physical AI infrastructure, and it is flowing into tangible industrial efficiency. You must be willing to adapt because the technological rotation we are witnessing is structural, it's not temporary.
It completely reorients how you view the entire market.
It really does.
And actually, there is one sort of unmentioned concept hiding in the margins of these sources that I want to leave you with today.
Oh, what's that?
We discussed Google paying nearly $1 billion a month just to rent compute space.
Right.
Well, if legacy empires are paying that kind of tribute just to access servers, it strongly suggests that AI computing power is becoming the new fundamental commodity of the global economy.
It is rapidly becoming the bedrock resource that every other innovation depends on.
Exactly. So, if compute is the new oil, if it's the raw resource powering global logistics, medical research, and military defense, what happens to this delicate market if that new oil experiences a severe supply shock?
Scary thought.
It is. I mean, if investors are sweating over the Bab el-Mandeb Strait disrupting traditional oil shipments today, imagine the total panic if the world's premier AI data centers suddenly go dark.
The market would completely freeze.
It absolutely would. That is something you should absolutely keep an eye on. Thank you so much for joining us for this deep dive. Stay curious, keep analyzing the data, and we'll see you next time.